Okay, in the last video now, we showed you, or I showed you how to calculate the intrinsic value of a stock if indeed you're going to have constant growth. And in this example, I'm going to show you how you calculate intrinsic value when you have non-constant growth. Now, here's what we had in the last problem. This was a company whose current dividend was $2 a share. Constant growth rate we expect is 6% per year, and the required return was 12%. Now, often analysts go and visit companies, and some of the people they like to talk to at any rate, is the research and development people. They're developing products that are going to impact the future, which is where the cash flows are that impact value. And they find that this company has developed or is developing products that they think is going to come to the market 6 months from now, will have a big impact on sales and revenues and earnings and all that kind of thing. And they do their analysis, and the analyst thinks that if this product they're having comes to market now, in the first year, they don't expect growth rather to be 6%. They expect growth to be 25% in the first year. And in the second year, they don't expect growth to be 6% then either. They think it's going to be 20%, and in the third year, 15%. Now, after the third year, they expect that the company is going to return to its normal historical pattern of 6% per year. Now, this is not unusual. You see declining expected growth rates. That's usually what happens. People come up with new products. Other companies get into it. They want to make some of the profits too. Economists call it ruinous competition. Okay? But you see a declining growth rate at some point. And companies can't grow at 25% a year forever. It's just physically not possible. They'd be the entire economy. So that doesn't happen. So over time, you see growth rates typically go down. Now, what I'm going to show you here, this is a non-constant supernormal growth problem. If you study for the Chartered Financial Analyst exam, if you've ever taken the exam, there's been a problem like this on every test. Okay? So this is something that analysts learn. They have to learn because most of them are indeed CFAs, and so they're made to learn this. Now, when you have non-constant growth or supernormal growth, there's 3 steps involved in coming up with intrinsic value. The first step now is to forecast your dividends. Now, the dividends you need to forecast are the dividends you expect to receive during supernormal growth, which is for the first 3 years here, and then one dividend past that. So in our little example here, we need to forecast D1, D2, D3, and D4. Indeed, if we do that, we start with a base of $2. That's D0. If it grows by 25%, if you take $2 times 1.25, you get $2.50. In the second year, again, we're not going to get constant growth of 6%, we're going to get 20%. Well, if you take $2.50 times 1.20, you get $3. And if you take $3 and multiply it by 1.15, the growth rate you expect in the third year being 15%, you get $3.45. Now, after that, we expect the company to return to its normal historical growth pattern of 6% per year. So when we get D4, we would come off a base of D3, $3.45, and we multiply by 1 plus the growth rate we expect after time period 3, which is 6%. And that gets us $3.66. So when you have non-constant or supernormal growth, the first step to finding intrinsic value, you need to forecast your dividends. Specifically, the dividends you expect to receive during supernormal growth, and then one dividend past that. And that's what you see on this top line up here. The second step now is to find the present value of the dividends received during supernormal growth. And I want you to note now, we have 3 dividends received during supernormal growth. These are all lump sum cash flows. To find their present value, we're going to multiply each of them by their PVIF, appropriate N and I. Now, this First dividend, $2.50 received 1 year from now. It's a lump sum cash flow. To find its present value, I'd multiply it by my PVIF at 1 and 12%. What you discount at now is always your required return. So you'll note all of these interest rates are all 12%. So if you look up your PVIF at 1 and 12% on your interest factor table, you get 0.8929. 250 times 0.8929 is $2.23. The second dividend is $3. That's what we expect to receive 2 years from now. To find its present value, we'd multiply it by our PVIF at 2 and 12%. And again, if you look up your PVIF on your table, you'll find 0.7972. So $3 times 0.7972 is $2.39. The third dividend we get during supernormal growth, $3.45, that's received 3 years from now. We multiply it by our PVIF at 3 and 12%, which is 0.7118. 0.7118 times 345 is $2.46. Now, these three things added up here now, that's the present value of the dividends received during supernormal growth. That's the second step. First step, forecast your dividends. Second step, find the present value of the dividends received during supernormal growth. Now the third step is to find the present value of all the dividends you expect to receive after supernormal growth. Now, as you stand there, December 31st, year 3, you look into the future and you see constant growth of 6% per year forever. What are we going to use? We're going to use the constant growth model. Now, to find the present value of the dividends received after supernormal growth, you first find the price of the stock you expect at the end of supernormal growth. Supernormal growth ends at the end of year 3, December 31st, year 3. You expect constant growth. Well, to find the value of the stock at that point in time, you don't want the current dividend, you want the next dividend, which is D4. You expect constant growth, you use the constant growth model, you take D4 and divide by K minus G. D4 is $3.66. You require a return of 12%, and you expect constant growth of 6% per year. 366 divided by 0.06 gets you $61. $61 now. That's the present value of all dividends received after supernormal growth, but valued 3 years from now. That's a lump sum cash flow valued 3 years from now. We don't want it valued 3 years from now. We want to find the present value of all those dividends. Take $61 multiplied by your PVIF at 3 and 12%. I want you to note now that those two interest factors are indeed the same thing. Indeed, December 31st, year 3, you just got a dividend check of $3.45, and we expect the price of the stock at that point to be $61. You take the value of those dividends 3 years from now, $61, multiplied by your PVIF at 3 and 12%, which is 0.7118. 61 times 0.7118 is $43.42. This is the present value of all the dividends received after supernormal growth. Add that to the present value of the dividends received during supernormal growth, and you'll have the present value of all future dividends, which is $50.50. I want you to note now, this price here, this intrinsic value, does not include this dividend here, D0. D0 is the past. You're only worried about future dividends, not past dividends. D0's in the past. $50.50. A wrong answer I usually see on a test, not all the time, but some of the time, in this case would be, they tell me that the value of the stock, the intrinsic value was $52.50. What they did was they added this dividend in. That's wrong. That's why I box it off here. I encourage you to do the same thing. You only want to find the present value of future dividends. $50.50 is the intrinsic value of this stock, assuming supernormal growth. So if you paid more than $50.50 for this stock today, then indeed you get a return less than 12%. Okay? $50.50. It assumes what? That you're going to have these growth rates in the future, and it's going to assume that you want a 12% return on your investments. If the price of the stock in the market is greater than this, that means that the stock is overvalued. You wouldn't buy the stock. You get a less than 12% return. If you could buy this stock today for, say, $45 a share, would you buy it? Yes. That stock is undervalued in the market, and if you buy it, you'll get a return greater than 12%.